Thank you so much for joining us here on a Monday. I'm Marlon Boulding with you on the Market Day Report. We're watching your ag commodity trade. And we are looking at your grain segment here for now in this first part. Now, I want to bring in Brian Splitt. He's with Allendale Incorporated in McHenry, Illinois. I'm going to visit about this grain market situation right now. And Brian, you were just telling me that there's a little bit of a delay in getting some data out from USDA this morning. What's up?
Sure. I don't know what the reason was, but those export inspections that we talk about every Monday morning were delayed by about 10 minutes, so those were just released. And what I can say is that for corn, soybeans, and wheat, we had a little bit of mixed messages. Really, corn was the benefactor of positive inspections versus last week, coming in at just shy of 1.4 million tons. We had only inspected about 840,000 tons last week. On soybeans, the inspections were for 281,000 tons versus 371,000 last week, while wheat inspections totaled 691,000 tons versus 658,000 last week. But in a positive note, inspections across the board were better than year-ago levels.
Okay, other than the grain inspections that have just cleared the wire, and we'll get those worked up here as soon as we can. Now, what else is affecting the market here today? Because we did see divergence between the soybean trade going higher and the wheat market really seeing a lot of pressure here today.
Yeah, I think the money flow is unwinding some spreads. We've got corn very neutral today. It's been trading just about unchanged for most of the session, about a 2.5 cent range. That's very quiet, low volume. Soybeans are seeing some buying. We did revisit the low end of a trading range at the end of last week. There was no selling at the low end of that range, and I think we're seeing some technical buying today. And with the wheat market, I just keep hearing chatter about the availability of wheat globally, and that's continuing to keep a lid on any rallies right now.
There's a whole lot of discussion going on about the condition of the wheat and whether all that damage has really been factored in by the trade. Do you think they're a little afraid to walk out too far out on that limb and assign a little more damage than what they currently are?
Yeah, well, so the tough thing with trading a market like wheat, and anytime you see an event that could provide some damage to the crop, is knowing also that it may not happen instantaneously where the USDA will recognize that damage. So we just had a report last week from the USDA, and any damage that might be there, it may take a little bit longer than what we've already had for the USDA to assess that and then lower their yields on the next report.
Saw a big move on the cotton market this morning. Boy, they were expanded limit up on that July contract, 500 points higher in the open. It's still up, but 262 now at 84.80. That's an interesting market over there, isn't it?
We've had very, very strong exports for cotton, and I think when you compare the pace that we're running compared to the pace that we would need to hit USDA's target, we're running well above and beyond that. I think that you had some millers that got caught without coverage for their needs, and weather is providing some definitely bullish underlying support to that market.
I heard some rumblings this morning that we may actually see some cotton acres shift over to soybeans. Have you heard anything in that regard?
Yeah, I've heard a little bit of chatter, and it'll be interesting to see how the whole acreage scenario plays out in the next 45 days. We'll get another report from the USDA at the end of the quarter, last day of June, and that'll give us the actual planted acres, and we'll see if that soybean number continues to grow. But right now, I think some are trying to put some support into soybeans because we might continue to see the soybean plantings behind the pace of last year and the 5-year average when we get the numbers this afternoon.
All right, Brian, I'll bring you back here in a moment. We'll talk a little cattle and hog market activity as well. Our guest, Brian Splitt of Allendale. We'll be back with more after this. Well, we continue our conversation with Brian Splitt of Allendale Incorporated in McHenry, Illinois, and following a very nice weekend in that part of the country. I assume the planters are rolling strong and everybody wants to get as much field work done as they can before the next weather event moves in, and probably a couple of days the way it sounds. I want to shift our attention here, Brian, to the livestock trade. And when we finished up on Friday, everything was all bulled up. You just couldn't get it much more bullish, especially on the feeder cattle side. So we're in expanded limit mode today on the feeder cattle futures. And when we opened up the live cattle and the feeder cattle trade today, we didn't see any follow through. In fact, looking at feeders right now, the August down $1.63, and now you have September down $2.40, October down $2.92 at $148.20 on that October contract. I'll jump back to the live cattle side here, Brian, and here we have the June down $2.30 at $122.88, and that's almost $3 off its earlier high. August down $2.16 at $119.62, and I pointed out a little bit ago that it's the nearby contracts on the live cattle that are the weakest, and isn't that technically considered to be a very bearish signal?
You know, we've had a continuation of the liquidation of front month cattle versus back end, and we still have a very high open interest in the June contract. The funds built a very long position in cattle as part of the rally that we've seen over the last several weeks, and you may still see these events where you know, the front end liquidation needs to continue, especially on the way down, where the funds continue to have that long position and they need out. The cattle market right now is the epitome of volatility, and depending on your time frame, you have traders on both sides of the market, you know, that are caught wrong at any given moment.
So on the live cattle futures, if we look at that on the June contract there, the nearby, we're now trading at $122.95. Okay, we had a few cash cattle that sold Friday afternoon. Very light trade, but it was more around the 130 mark. That was in Colorado sales. So we're still running several dollars under the cash market, and yet we're pushing the market downward anyway. Are they expecting a steep decline in cash this week?
Well, and that's always going to be the argument when you've got the futures market trading at a steep discount to the cash is, will the futures rally as they have been? So we've seen several of the contract expirations where futures have needed to rally to meet cash. But I would think that at some point that pattern changes and we're going to see the cash market collapse to meet futures lower. Whether that happens on June or not, I don't know the answer to that. But that at some point there's the belief that we're going to have the animals available to have cash trade significantly lower.
Brian, good stuff. Thank you for joining us today. Brian Splitt of Allendale Incorporated in McHenry, Illinois. Here's a quick look at our lean hog trade, too. With the cattle market going down, the lean hogs have been trying to hold their own. We have June down a nickel, July now up 25, Christina, at 78.85. That's only a dime from its high of the day, August at 40 cents. So kind of quiet in the lean hog trade, though.
Okay, we'll keep watching. Thank you.
They're kind of on their own.
Markets editor, Marlon Bowling.